Stop scrolling. This could affect your Social Security check. If you're collecting Social Security or planning to retire soon, you need to hear this right now. Brand new SSA rules just went into effect today, and they could mean the difference between getting the maximum benefits you deserve or leaving thousands of dollars on the table. Here's what nobody's telling you. The Social Security Administration just implemented changes that affect cost of living adjustments, earnings limits, and how your benefits are calculated. Whether you're 62, 67, or already retired, these updates could directly impact your monthly check. And most people have no idea this is happening. We're talking about potential changes to the earnings test threshold, updated COLA calculations, and new qualification rules that could either boost your payments or catch you completely off guard if you're not prepared. The timing matters because understanding these changes now gives you the strategic advantage to maximize every dollar you've earned over your lifetime of work. In the next few minutes, I'm breaking down exactly what changed, who's affected, and most importantly, the specific action steps you need to take this week to protect and optimize your Social Security benefits. This isn't theoretical. This is money in your pocket or money left behind. If this information could help you or someone you love, smash that like button right now so more people can see this critical update. All right, let's dive straight into what's happening because time is absolutely critical here. The Social Security Administration doesn't make major changes every day, and when they do, the ripple effects touch millions of Americans who depend on these benefits for their daily lives. What we're seeing right now is a convergence of several policy updates that have been in the works for months, and they all just became official. The problem is that the SSA doesn't exactly send out personalized alerts to every beneficiary explaining how these changes apply to their specific situation, which means you've got to be proactive about understanding what this means for your financial future. Let's start with the most immediate change that's going to affect a huge number of people, and that's the earnings limit adjustment. If you're someone who decided to claim Social Security benefits early, maybe at 62 or 63, but you're still working either full-time or part-time, this is absolutely crucial information for you. The earnings limit is essentially a threshold that determines how much money you can make from work before the Social Security Administration starts reducing your monthly benefit check. Now, under the old rules that were in place just yesterday, if you were under your full retirement age for the entire year, you could earn up to a certain amount without any penalties. But here's where it gets interesting. The new rules have adjusted that earnings threshold, and depending on your situation, this could either be fantastic news or something you need to plan around very carefully. The specific number has increased, which on the surface sounds like great news for everyone, right? Well, not quite so fast. What this means is that if you're earning income from work and you're below that threshold, you won't see any reduction in your Social Security benefits, and that threshold has gone up. But here's the critical piece that most people miss completely. The Social Security Administration doesn't count all income the same way. They're specifically looking at earned income, which means wages from a job or net earnings from self-employment. Investment income, pension payments, rental income from properties you own, those don't count toward this earnings limit at all. So you could be collecting substantial income from investments, and it wouldn't affect your Social Security benefits one bit. But if you're working a regular job or running your own business, every dollar you earn counts toward that limit. Now let's talk about what happens when you exceed that earnings limit, because this is where people get really confused and sometimes make costly mistakes. For every $2 you earn above the limit, the Social Security Administration will withhold $1 of your benefits. Notice I said withhold, not permanently take away. This is a temporary reduction, and here's something that provides a bit of comfort. When you reach your full retirement age, the SSA will recalculate your benefit to give you credit for those months when your benefits were reduced or withheld. They'll adjust your payment upward to account for this, so you're not losing that money forever, but you are experiencing a cash flow reduction in the present moment, which for many people can create financial stress if they're not prepared for it. There's also a special rule that applies in the year you reach your full retirement age, and this is where the new changes get even more nuanced. In that specific year, there's a higher earnings limit that applies only to the months before you hit your full retirement age, and the penalty structure is different too. Instead of withholding $1 for every $2 over the limit, they withhold $1 for every $3 you earn above this higher threshold. The new rules have adjusted these numbers as well, and if you're turning your full retirement age this year, you need to know exactly what these figures are so you can plan your work schedule and your income accordingly. Let's shift gears and talk about the cost of living adjustment, because this is probably the change that gets the most attention every single year. The COLA is designed to help Social Security benefits keep pace with inflation, ensuring that your purchasing power doesn't erode over time as prices for goods and services increase. The new COLA that just took effect is based on inflation data from the previous year, specifically the Consumer Price Index for urban wage earners and clerical workers. Now, without getting too deep into the economics here, what you need to understand is that this year's adjustment might feel different from what you experienced in recent years. Over the past couple of years, we saw some pretty significant COLA increases because inflation was running hot. We're talking about adjustments that were well above the historical average, which provided meaningful increases to monthly benefit checks. But as inflation has moderated, the COLA for this year reflects that change in the economic environment. Some beneficiaries might feel disappointed if they were expecting another large increase like they saw previously, but here's the important context. A smaller COLA actually reflects positive economic news because it means prices aren't rising as rapidly as they were before. Your previous benefit increases are permanent, so you're starting from a higher base amount, and any additional COLA, even a modest one, builds on top of that higher foundation. What makes this particularly relevant right now is how the COLA interacts with other aspects of Social Security, specifically the maximum taxable earnings cap. This is the amount of your earnings that are subject to Social Security taxes throughout the year. This cap also adjusts annually, and the new figure that just went into effect is higher than last year's cap. If you're a high earner who typically hits this cap every year, you're now paying Social Security taxes on a larger portion of your income. From the government's perspective, this helps ensure the long-term sustainability of the Social Security program. From your perspective as a taxpayer, it means a bit more money coming out of your paycheck if you're still working and earning above this threshold. Now, here's something that doesn't get nearly enough attention, but can have massive implications for your overall retirement strategy. The way your Social Security benefit is calculated in the first place is based on your highest 35 years of earnings, adjusted for inflation. If you continue working and earning money, especially if you're earning more now than you did in some of those earlier years, you could actually replace some of those lower earning years in your calculation with higher earning years, which would increase your overall benefit amount. This is something you can take advantage of regardless of whether you've already started collecting benefits or not. Let's say you claimed benefits at 62 because you needed the income, but then circumstances changed and you went back to work. Every year you work and earn substantial income, the Social Security Administration will automatically recalculate your benefit if those earnings improve your calculation. You don't have to do anything special or file any additional paperwork. They handle this automatically, and you'll see your benefit amount increase to reflect those additional high-earning years. This is a strategy that not enough people utilize because they assume that once they start collecting Social Security, their benefit amount is locked in stone. But that's simply not true. Another critical aspect of these new rules involves how benefits are coordinated for married couples, particularly around spousal benefits and survivor benefits. If you're married, you have the option to claim benefits based on your own work record or based on your spouse's work record, whichever provides you with a higher benefit amount. The rules around this haven't fundamentally changed, but the way the new earnings limits and COLA adjustments affect couples requires some strategic thinking. For instance, if one spouse is significantly older than the other, or if one spouse had much higher lifetime earnings, there are specific claiming strategies that can maximize the household's total Social Security income over both lifetimes. Survivor benefits are particularly important to understand, especially for women who statistically tend to outlive their husbands. When one spouse passes away, the surviving spouse is entitled to receive the higher of their own benefit or their deceased spouse's benefit, but not both. This is why it often makes sense for the higher-earning spouse to delay claiming benefits as long as possible, even up to age 70, because doing so not only maximizes their own benefit while they're alive, but also maximizes the survivor benefit that will continue for the rest of the surviving spouse's life. The new COLA adjustments apply to survivor benefits just like they apply to retirement benefits, so that protection against inflation continues even after one spouse passes away. Let's talk about something that creates confusion for almost everyone, and that's the taxation of Social Security benefits. Yes, you read that right. Depending on your overall income level, a portion of your Social Security benefits may be subject to federal income tax. This seems unfair to a lot of people because you already paid taxes on that money when you earned it during your working years, and now the government is taxing it again when you receive it as benefits. The reality is that the tax treatment of Social Security is based on what's called your combined income, which includes your adjusted gross income, any non-taxable interest you receive, and half of your Social Security benefits. If your combined income exceeds certain thresholds, then up to 50% or even 85% of your Social Security benefits could be subject to federal income tax. These thresholds haven't been adjusted for inflation in decades, which means that more and more beneficiaries are finding themselves subject to taxation on their benefits as their overall income rises. This is something you need to factor into your retirement planning because it can significantly affect your net after-tax income. Some people are shocked when they file their taxes for the first time after claiming Social Security and discover that they owe money to the IRS because they didn't have enough tax withheld from their benefits throughout the year. You can actually elect to have federal income tax withheld from your Social Security benefits, just like you would from a regular paycheck. This is done by filing a Form W-4V with the Social Security Administration, and you can choose to have 7, 10, 12, or 22% withheld. This is a smart move if you know you're going to be subject to taxation on your benefits, because it prevents you from having a big tax bill at the end of the year or owing penalties for underpayment of estimated taxes. Here's something else that's incredibly important but often overlooked. If you're receiving Social Security disability benefits rather than retirement benefits, these new rules can affect you too, particularly around work incentives and trial work periods. The Social Security Administration has specific programs designed to encourage people on disability to return to work if they're able to do so, and these programs have earnings thresholds and time limits that have also been adjusted. If you're on disability and you're considering attempting to return to work, you need to understand exactly how much you can earn and for how long before your disability benefits might be affected. As we wrap up here, I want to emphasize that these changes aren't happening in isolation. They're part of a broader landscape of retirement planning that includes your personal savings, any pensions you might have, your investment portfolio, healthcare costs, including Medicare decisions, and your overall life expectancy and health status. Social Security is designed to be one leg of a three-legged stool, along with personal savings and pensions, supporting your retirement income. Understanding exactly how these new rules affect your specific situation allows you to make informed decisions about when to claim benefits, how much you can earn from work, and how to coordinate Social Security with your other income sources. The bottom line is this: knowledge is power when it comes to Social Security. These new rules create both opportunities and potential pitfalls, and which category you fall into depends entirely on your individual circumstances and how well you understand the system. Don't leave money on the table because you didn't take the time to learn how these changes affect you personally.